Imagine putting your hard-earned money into the stock market for the very first time. You buy a stock because everyone online says it's the next big thing. A week later, it drops 20%. Panic sets in. You sell, relieved to stop the bleeding. A month later, that same stock doubles. Sound familiar? If it does, you're not alone. The biggest threat to new investors isn't a lack of intelligence, it's the way our minds are wired. Our brains evolved to help us survive, not to build wealth. In everyday life, following the crowd can keep us safe. In investing, though, it often leads us straight into costly mistakes. That's why investment psychology matters just as much as picking the right company. Take David, a young professional who started investing after seeing friends boast about quick profits. Every day he refreshed his portfolio, chasing whatever stock was trending. When prices rose, he felt invincible. When they fell, fear convinced him to sell. After a year of constant buying and selling, he realized something painful. The market wasn't beating him, his emotions were. The first mental trap is FOMO, the fear of missing out. Seeing others make money creates the illusion that you must act immediately. Legendary investors know the opposite is true. Warren Buffett often reminds us that opportunities never stop coming. Missing one investment won't stop you from becoming wealthy, but chasing every hot stock just might. Another trap is herd mentality. When everyone seems excited about one investment, it feels safer to join the crowd. Yet history shows that the crowd is often most optimistic near market peaks and most fearful near market bottoms. Great investors are willing to think independently, even when it feels uncomfortable. Then there's overconfidence. After a few successful investments, many beginners believe they've mastered the market. Charlie Munger often emphasized that humility is a competitive advantage. The market has a way of reminding us that luck and skill aren't the same thing. Loss aversion may be the strongest trap of all. Studies in behavioral finance show that people feel the pain of losing money much more intensely than the joy of gaining it. That's why investors panic during market downturns. Howard Marks has long argued that market cycles are inevitable. The investors who succeed aren't those who avoid volatility, they're the ones who prepare for it emotionally. Confirmation bias quietly reinforces bad decisions. Once we believe a stock is a winner, we search for information that agrees with us, while ignoring warning signs. The smartest investors actively seek opinions that challenge their own thinking, because they know confidence without evidence can become expensive. Recency bias is another silent enemy. When the market has been rising for months, it feels like it will rise forever. During crashes, it feels like it will never recover. Yet history repeatedly tells a different story. Markets move in cycles, but human emotions remain remarkably consistent. So how do you avoid these traps? Build a simple investment plan before emotions take over. Invest consistently instead of trying to predict tomorrow's headlines. Diversify your portfolio. Review your investments with patience rather than reacting to daily price movements. Most importantly, remember that successful investing isn't about making perfect decisions. It's about making disciplined ones repeatedly. Legendary investors didn't build extraordinary wealth because they could predict every market move. They built it because they mastered themselves. The stock market is less a test of intelligence and more a test of emotional control. The next time you feel the urge to chase a soaring stock or sell in fear, pause for a moment and ask yourself one question. Is this decision driven by evidence or by emotion? That single habit could save you from the biggest mental trap of all, believing that your feelings are facts. In investing, the greatest edge isn't finding the perfect stock. It's developing the mindset to stay calm when everyone else is losing theirs.